So when we think about monetary policy, we want to think about how policy interest rates, right, the federal funds rate in the United States, ends up affecting both aggregate demand and then how that affects inflation, right? Because the central bank, like the Federal Reserve, is trying to balance two goals. One is they want aggregate demand to be strong, the unemployment rate to be low, but they also want to control inflation, right? And so the central bank usually has some sort of inflation target, whether that's explicit in like the for the European Central Bank or the Australian Central Bank, or whether it's sort of more implicit, like for the Federal Reserve. And so when they set the policy interest rate, that's going to have an effect on market interest rates. It's going to have an effect on asset prices. It's going to have an impact on expectations and confidence, and it's going to impact the exchange rate. Those four pieces, which we'll look at individually, will then impact domestic aggregate demand, right? So aggregate demand in our own country, plus net exports, right? How much exports we have, how much we import. That added up together is aggregate demand. Those two will impact domestic inflationary pressure. The exchange rate will also impact import prices, and that will lead to inflation. So these are all things that the central bank is trying to balance. So there's no sort of silver bullet and key, equation that they can put in. They look at all of the data sort of on an ongoing basis and change where they want to put their policy interest rate, right? So what they do is they kind of work backwards. They look at the economy. How is it doing? Is inflation too high? Is inflation too low? How is the unemployment rate? Are we in a recession? Are we in an expansion? How can we change the policy rate, right, the nominal policy rate, to uh, affect the market interest rate, right? And so the market interest rate is going to be important because it's going to affect investment specifically, right? Residential investment, building new houses, but also business investment as well. In terms of asset prices, then this can also be important because asset prices, so we can be talking about stock prices, bond prices, and especially housing prices, can affect the rest of the economy, right? When the interest rate goes down, that is going to increase the price of assets. And households who own assets, which for financial assets like stocks and bonds will be mostly the very wealthy, but for housing will be a broader swath of households, that can increase their consumption. This is not without danger, though, right? If the Federal Reserve or the central bank decreases interest rates for too long, that can push up the price of assets into unsustainable territory and create an asset bubble. And so there's certainly an argument that has been made that interest rates were kept too low, sort of from 2000 to 2006. And that is one of the things that increased the housing bubble. I don't think it's the main cause of the housing bubble, but it certainly is as part of the story, probably. Expectations are also going to be very important, right? So part of the goal of central banks is being as consistent as possible and having good communication with the public, so that firms will expect higher demand. If they expect higher demand, then they're going to increase their investment. Increased investment is going to increase aggregate demand, etc. Also, households who are more confident will be more likely to buy, those durable goods, those cars, those refrigerators, those washing machines, and that will increase aggregate demand as well. And so, someone like Janet Yellen, who is the chair of the Federal Reserve, is always very careful in her public comments because she knows that, a lot of the market is listening to what she says, and she wants to be both reasonable and accurate, but also try to build that confidence in the public. Finally, there's the exchange rate. So remember, the exchange rate is how much currency of one country you can be exchanged for currency in a foreign country. So it could be the yen dollar exchange rate, it could be the euro yuan exchange rate. Those exchange rates are going to be important, and the changes in interest rates can change the demand for home currency. There's this huge market for foreign currency. So, for example, if the United States lowers interest rates, people aren't going to want to buy as many US bonds because they pay a lower interest rate. That's going to affect the demand for dollars. And then that can affect the demand for imports and exports, right? As the exchange rate changes. A stronger exchange rate where the dollar is stronger makes imports cheaper, but exports more expensive. And so that's going to result in lower net exports because imports will go up and exports will go down. A weaker dollar, where the dollar buys less of a foreign currency, will mean that imports are more expensive, and so we will import less, but exports are cheaper, so we will export more. So how is this going to work? Well, the goal, if we just look at this in terms of the multiplier model with aggregate demand, if we hit a recession, right, if we go from point A, aggregate demand shifts lower, perhaps because of lower consumption, and we go down to point B, monetary policy says, all right, well, we need to decrease the interest rate to some R prime in order to shift us back to point A. Now, this is what the Federal Reserve tried in 2008, 2009, 2010, but they dropped the policy rate, the federal funds rate, all the way down to zero and then couldn't drop it any further. And so that's one of the reasons that economists say we should have a slightly higher uh, inflation rate, because a slightly higher inflation rate would mean a higher nominal interest rate, which would give us more room to cut during a recession.